If you are looking for an investing strategy proven to make money, then look no further than the contents in this video. We're going to break this up into 5 phases, each of which are equally as important. So watch the video fully through and get ready to invest like the rich. Phase number 1, we are talking about the Automatic Millionaire. Now this concept is saving a percentage of your income consistently over time. So firstly, you have to understand the percentage principle in savings. Imagine that your income is like a pie. Now, no matter the size of the pie, what matters for your future is how much of it you keep for yourself. Instead of saving whatever is left after spending, you save first. Set aside a fixed percentage of your income, be it 10%, 15%, or even more, depending on your circumstances. This part of your income pie is your ticket to future wealth. It will remain untouched and unspent, a small fortune that you start building the moment that your income hits your bank account. Now, how do you ensure that you stick to the savings routine? The secret lies in automation. Use the digital tools at your disposal to make this process automatic. Set up a direct debit or standing order with your bank, transferring a set percentage of your income into a separate savings or investment account. By doing this, you are paying your future self first, and it happens without you needing to lift a finger, think about it, or even miss the money. It is the set it and forget it approach to building wealth, preventing you from unintentionally or intentionally spending your future wealth on today's temptations. The third step here is consistency. 1 or 2 months of saving isn't going to build you a fortune. The real magic happens when you are consistent over time. Every paycheck, a portion of money will invisibly and automatically vanish into your wealth building pot. Over months and years, this is less of a repetitive task and more of a wealth building habit. Consistency beats random acts of savings, turning tiny regular contributions into a mounting sum of money. Now lastly, understanding that this isn't a get rich quick scheme, but rather it's a slow and steady approach and reliable approach to growing your money. Now with your savings now happening automatically and consistently, the final ingredient here is time. The longer that your money sits into an investment account, the more interest that you're going to receive and the more that it will grow. This is the magic of compound interest, where you earn interest on the interest on your savings or on your return on investments. Years of consistent automatic savings can grow into a sum that will automatically make you a millionaire. Phase number 2, often dubbed the 8th wonder of the world, compounding plays a massive role in the benefits of long-term investing. When you reinvest the dividends or earnings from any investment, it grows not just on the original sum, but also on the returns you've already gained. Now, over short periods of time, the effect of this might be minimal, but given enough time, the power of compounding can lead to exponential growth of your investments. Here is an analogy that has always struck with me in understanding this concept. Imagine that you plant a single seed in the garden. Now, this seed grows into a tree with 100 apples, and each apple has a seed inside. You then go ahead and plant each of these 100 seeds. Now, instead of 1 tree, you have 100 trees. That is essentially how compound interest works. Instead of earning growth on just the initial amounts of money that you put aside, which is called the principal, you are earning growth on the growth, which accelerates the increase of your total savings over time. So let's take that and now apply it to the real world. Imagine that you start a savings account with $1,000 with the intention of becoming an automatic millionaire. You decide to contribute an additional $100 every month. You invest in an asset class that pays you a rate of 5% return per year. And this interest rate is going to compound, meaning that it is going to add to your balance annually. Now, with each new year that passes, the interest rate you earn will be higher because the principal is now higher. So here's how it works. Let's say you start off with the balance of $1,000 that you put into an investing account, and we could call that year 0. Now, the first year, you make a contribution of $100 per month. For 12 months, that's an extra $1,200 added to your already $1,000 investment. So by the end of year 1, with your new contributions, you have a total of $2,200. $200. And let's say you earn 5% on that money. Well, then you will earn $110 as your interest payment. So now at the end of your first year, from your initial investment plus your contribution plus your interest payment, you have $2,310. So this $110 is the free money that you've earned simply by letting your funds sit in your investing account and just adding to it monthly. But the magic of compound interest only becomes clear in subsequent years as you earn interest not just on your starting balance, but also on the interest from the previous years. So let's go forward and take a look at year 2. Let's say you make the same amount of contributions, right? So $100 each month, so that's another $1,200 for the year. And then from that total, you get paid again 5% as an interest payment. This means that you're going to get paid $175.50, which is the 5% of the money that you have invested. This brings your grand total for the end of year 2 as your initial starting balance, $2,310, plus $1,200 your contributions, plus $175.50 your interest payment, for a grand total of $3,685.50. Now notice that in the second year, you earned $175.50 of interest, which is significantly more than the $110 that you earned in the first year. This increase happens because you earned money on the interest from the first year as well. So fast forward to 30 years with the same pattern, and you will see that a significant portion of your savings would come from the interest earned, not just the money that you have saved. This exponential growth happens thanks to compound interest. So you can sit back, relax, and watch your apple seed become an entire field of apple trees. Markets are inherently volatile in the short term. Prices can swing wildly due to immediate reactions from the news, earnings reports, or geopolitical events. So let's take a look at market volatility and how we can easily come ahead of it. Market volatility refers to the rapid and significant price swings of stocks or market indexes like the S&P 500. Take a look at the 2008 financial crisis or the 2020 market crash triggered by the pandemic. During such periods, it's not uncommon for markets to experience drops of 20% or 30% or even more, causing many investors to panic and will sell their stocks out of fear. However, historical market data supports our long-term strategy, staying invested and continuing your regular investment contributions regardless of what the market conditions are. So let's use the S&P 500 as an example. Despite considerable short-term losses during market downturns, the index has provided an average annual return of around 7% after adjusting for inflation over the past several decades. And this is the reason why consistency is key. If you had begun investing $100 a month into the S&P 500 index starting in 2008, which was the market low due to the financial crisis, and continued this regardless of market conditions, your total contributions would be $19,200 by 2020. However, due to the market's recovery and growth in the subsequent years, your investment value in 2020 would be significantly higher, despite the significant downturn that particular year. This idea is called dollar cost averaging. By investing a fixed amount regularly, you buy more shares when prices are low and fewer shares when prices are high. Now, this approach not only reduces the risk of investing a large amount of money during a market high, but also removes the need to time the market. Long-term investing, therefore, acts as a countermeasure to market volatility. While downturns lead to lower stock prices, these periods can be viewed as opportunities where shares are on sale rather than as a pure loss. By maintaining regular investments, you take advantage of these lower prices, which can lead to greater potential growth when the market eventually, and it will, recover. This disciplined approach, supported by historical market trends, suggests very clearly that despite short-term market volatility, the long-term investor, that's you, is positioned to grow their wealth. So now that you better understand the concept of dollar cost averaging and doing this consistently for a long period of time, the question still remains, okay, but what do I invest in? This is where a balanced and diversified portfolio comes in. Now, the easiest thing to do is buy index funds, right? Or ETFs that track the entire US stock market. This will automatically spread your investments amongst the top companies on the stock exchange, and this historically has been the number one place to invest your money. Don't try to pick stocks yourself. Don't try anything fancy, just buy the S&P 500 consistently for decades to come, and you pretty much will guarantee to be a millionaire. Many investment firms have mutual funds that you can invest in as well, and to keep things balanced, will offer bonds to balance out risk. Now, this composition of stocks and bonds is fundamentally influenced by the investor's age, risk tolerance, and investment horizon. Younger investors, for example, generally have a longer time frame to cushion market fluctuations and can therefore allocate a larger portion of their investments to equities. Now, a typical example might be an individual in their 20s or 30s allocating 80 or 90% of their portfolio to stocks. Again, buying something like a fund that tracks the S&P 500. Or if you're going to choose individual stocks, then pick the top companies in different sectors. Now, if you're going to choose individual stocks, a smart thing then to do would be to pick the top companies in different sectors. So Apple and Google for tech, for example. Companies that have been around forever and have a proven track record. Now, in contrast, older investors approaching retirement have shorter time frames and often seek to preserve capital and maintain a steady income stream. They might shift their portfolio balance towards more conservative investments. For example, somebody in their 60s might have 60% of their portfolio in bonds, such as US Treasury bonds, which are backed by the full faith and credit of the US government, and maybe corporate bonds as well, right, from highly rated companies. These fixed income securities provide the dual benefit of regular income through interest payments and the return of principal at maturity. Now, at the end of the day, as long as you stick to a strategy, dollar cost average, and do it into historically sound investments, then investing should be very simple. Of course, there is still something that might throw you off track. Now, before we get into that, I want you to download a free investing checklist that I put together. Now, this is your blueprint for investing that will lay out everything that you need to know step by step about your long-term investing journey. Trust me, this will help build your strategy and keep you on track so that you can have something that has a full picture of what you want to achieve. So the first link in the description is your free checklist. Go ahead and download it and use it wisely. Phase number 5 is your emotional stability. Now, one of the biggest challenges in investing is managing emotions. Fear of missing out, panic during downturns, or greed during booms can lead to poor decision making. Long-term investing provides a psychological buffer against these impulses. So for instance, consider again the example of the financial crisis that began in 2008. As stock prices began to plummet worldwide, panic ensued amongst many investors. Those who got swept up in the fear sold their stock and cut their losses, believing it would save their portfolio. However, this emotional decision locked in their losses and prevented them from benefiting from the market's eventual recovery. Now, in contrast, the S&P 500 recovered from its low point and reached all new highs the following years. Now, if those investors had held onto their stocks, they likely would have recovered their losses and possibly even achieved positive returns. By acknowledging that downturns are a natural part of the market behavior, then you are less likely to react out of fear or greed. So remember, stick to your consistent investment plan. And the plan is, again, investing a set percentage of your income regularly over time, regardless of the market conditions, and take emotions out of it. Don't forget to get that free investing checklist with the link down in the description below. Thank you all so much for watching this video. You are on your way to becoming a great investor. And to help you out some more, I got this video and this video. Give them a watch, and I will see you on the next one.